Hey, happy Wednesday. This is Josh Jenkins. For those who don't know me, I see that we have a couple people slowly starting to join, so that's great. Happy Wednesday, happy hump day. So, what we're going to do is we're going to give it about 2, 3 minutes and get started with the webinar. I see that we have people trickling in, and then this will be recorded with the goal for me to send this out to a couple dozen people who said, "Well, why is it 12 o'clock on a Wednesday? I'm still working." I'm like, "No problem. We'll send it afterwards." So excellent. So for those who don't know me, right, I'm located in South Central Pennsylvania, a little place called Mechanicsburg. And I've been working in financial services since 2012. And I wish I knew then what I knew now, but that's just how life goes. Whenever I first started, I joined an insurance first company, and that was a good home for me. It taught me how to sell myself. It helped me become one of the youngest certified financial planners in all of Pennsylvania. I realized early on I didn't know a lot. I need to learn. And I quickly went and picked up other credentials and wanted to be the best version of myself. Someone early on told me you can either baffle people with bull or you can blind them with brilliance. So I made sure that I got all these credentials that are the typical credentials: an accredited estate planner, one of the hardest ones I got, certified financial planner, chartered life underwriter, really wanted to understand how insurance worked, chartered financial consultant, retirement income certified planner. So those are designations I had, but imagine my surprise that when I started going upstream, when I started working with really wealthy individuals and having what I call either bourbon conversations, cigar conversations, golf conversations with these people, I see one of them on this call who is a billionaire, right? The conversations there switched. And what I found to my dismay is all this knowledge that I picked up over the first 5 to 10 years of my career, it really focused on selling investments, selling insurance, helping people with some very basic rudimentary type of planning, making sure that they're maxing out their 401k, teaching them some concepts such as a Roth conversion strategy, which is a great strategy to still pursue. So doing some things like that, making sure that you have some analysis. But again, these conversations that we're having focused around different alternative assets, which I had no idea about. Even though I have enough designations and I've read enough books to fill a room, it feels something was missing. There was a disconnect between the knowledge that we were presented in a traditional financial sense and the advice or implementation that truly wealthy people were doing. And it really struck me hard when I met this person named Mike in 2015, showed me that every single year is making millions of dollars, but every single year his tax bill was less than what I was paying. I was like, how's he doing this? And so what I did was that embarked a journey for me to actually understand what the truly wealthy do. And that's what I did when I put together this. What I did was I took my firm independent in 2023. And so Jenkins Financial, we're still located in South Central Pennsylvania, but we had to go independent. We couldn't join another firm. I would have loved to join another firm because when you go independent, they don't pay you anything. You don't get paid. If you join Merrill Lynch, they offer you $9 million bucks, but it is what it is, right? The goal was to say, hey, I want to provide the level of advice that I'm seeing these very small group of advisors give to these billionaires, to these people that are worth a lot of money. And I'm seeing it hit the pocket where it matters most. So it is 12:04. We're going to go ahead and get started with the webinar. What I have a Q&A at the bottom. I encourage you to go ahead and type any questions as we start talking, and either we'll answer them live right then. I have one of my staff who's working right beside me, Josh Lebo, so that way we can make sure we address these questions, if not then at the very end. The goal today is to hit on 4 concrete ideas that the wealthy are doing and doing differently than the typical advisor, 1, knows about, 2, right, wants to talk about because they don't get paid on that, or 3, have any type of degree or competency in. So we're going to discuss, like I said, 4 key areas, and I try to break it down in easy to use helping us understand a 10,000-foot view on the pretty much some complex just arrangements. So without further ado, I'm going to go ahead and get started and share my screen. All right. So what your advisor isn't telling you, probably. So the first thing to address is like, okay, Josh, how do I know that this conversation is for me? Or maybe you're just searching to say, I really just want to understand. Maybe I'm not there yet, but how do I know that I've arrived? That maybe I should be taking a look at implementing in the future some of these suggestions. Remember, today is not around me making individual recommendations to anyone. I don't know your situation, right? Unless you're a client of mine already. I see a few of them on here. The goal is for me to provide advice for you to educate yourself in some of these key areas. If you'd like to engage Jenkins Financial in some way, shape, or form, that's going to be on you. So how does talk this for you, right? Number one, taxes hurt. I don't mean like, oh, I pay taxes. I mean, every single year you take a look at your tax return and you're wondering, is there something that can be done to get this down more than just maxing out my 401k? What amazes me is a lot of advisors, that's all they know is to max out your 401k. And that's pretty much all that's in their repertoire to try to reduce taxes now. Just remember, there's three different types of taxes. There's taxes you have now. There are taxes that you potentially have when the money grows. And there's taxes that you have at exit, i.e., right, with the retirement account pulling money after 59 and a half, or maybe a successful exit of a private equity firm where your 100 grand turns into 500 grand. There's different types of taxes that need to be discussed. And a lot of times they can be, if not eliminated, drastically reduced by putting those funds in a different spot. Tax in the six-figure range. You're already set for retirement. This conversation is not for those who are just starting out, who have not yet maxed out their 401k, who are not already saying, you know what, Josh, it's a done deal. I know I'm on track for my financial goals. I'm saving enough for my kids' education. Of course, I have enough for retirement, but there has to be something more. My Merrill Lynch advisor tells me just keep doing the same thing of putting more money into investments and insurance. There has to be something else. I'm already set. Next is you're selling a business or stocks at some point with a tax liability. This is the biggest area that I focus in. People come to me and they pay my fee because what I do is I take a look to say, hey, if you're selling this business for $15 million, I work with your accountant to determine how much is going to be recaptured, i.e. income tax, how much is going to be subject to capital gains. And then we start working on a plan, hopefully months and months out, at least before the end of the year, for us to position those dollars to have the maximum tax impact. We've had several conversations recently where we've lowered the tax liability by over 7 figures. Right? And we'll discuss some of those concepts here today. You know, this talk is for you if your advisor keeps recommending the same thing that sounds like a beaten drum. Buy more insurance, right? Maybe it's buy an annuity, right? The hint is, and I tell people typically stay away from annuities, right? Not a fan of them. That's a different conversation. And the last one is an accredited investor. Accredited investor means as an individual, you're making over 200 grand a year. As a married couple, you're making over $300,000, or you have a liquid net worth of $1 million or more, excluding the value of your primary house. And the reason why that is a lot of these investments that we talk about, some of them you're not allowed to invest in. The bare minimum is that you have to be an accredited investor. This is not meant to bar people. This is meant to protect people because these types of investment strategies are what's considered sophisticated. Right? Again, these are not for people that are not okay with loss, right? This talk is not for you if already year to date, you've called your financial advisor 30 times, freaking out about the stock market because bigger picture is, right? We talk about this is that ups and downs are just part of the game. And so if you understand how that market works and you're okay with risk and you're a accredited investor, then these types of concepts really should be coming to the forefront of your mind. And you should be discussing, hopefully, with a competent CPA and CFP, hopefully they know these, but I'll tell you from experience, just because I've gone out there and I've done seminars to different accountant firms, that a lot of accountants don't know these types of strategies. It's nothing against them, right? I love accountants. They do my taxes too. But at the same time, their job isn't necessarily to try to help you avoid taxes. It's just to help you figure out your tax liability from the sale. So let's get down to brass tacks. This is the first of 4 strategies that not only have my clients employed, but I've done myself, right? Anything that I recommend to my clients or just part of a strategy, these are well thought out things that I've experienced myself. Real estate. Real estate's a buzzword. And I'll tell you, real estate is very similar to the stock market. There are really good types of real estate, and there's also really bad types of real estate too. There's real estate that's considered more speculative, could make you more money, or you could lose your shirt. What it takes is a strategist and a guide to try to help you figure out what types of real estate, and if you do it correctly, how can we go ahead and save money in taxes? Now, why I like real estate is very simple. It has 3 main components, which is when you buy real estate, if it's an income producing property, you have income every single either month or quarterly or however it's set up with your property manager. You have appreciation potential. That townhome community that you bought for $2 million has the potential to appreciate over time so you can sell for a successful exit. And the next thing is a concept that a lot of people, again, I want to broach it now, and we're going to address it again in about 30 minutes. It's the concept of leveraged returns. It's a concept that as you move up market, debt necessarily is not bad, right? I'm going to put a caveat on that. Sometimes my clients think that their line of credit they have with me is money to be used to buy a car, or it's money to be going on a really cool golf trip. And that's not the point, because if that type of debt is what you're accumulating, it's not income producing. Whenever you take a mortgage out to buy an income producing beach house or an income producing property or a house that you're currently flipping, right? I'm flipping 3 homes right now. That then turns into an asset. The concept of leveraged returns, I'm going to hit on very, very briefly, and doesn't matter if you don't quite get it right now, we're going to hit on it again, but it's this concept of this, right? You're going to get to know me. You're going to understand that I love short-term rentals. We're going to talk about why. But if I buy a beach house for $1 million and that beach house makes $100,000, let's say that I paid all cash, right? What is my cash on cash return? What I mean by that is I put $1 million in, and after fees, I made $100,000. That's a 10% return on your money. That's pretty good. Well, what if Josh sitting right next to me buys the identical house right next to mine, buys it for $1 million, but he decides to finance it instead, right? And he finances his beach house and he puts $800,000 in financing and puts $200,000 down. Now he makes the same return. He makes $100,000, but now he has to pay this interest charge. For just all sakes, intents and purposes, let's say that the interest charge is $60,000. So he didn't make 100, he made 40. Well, what is that? Did he make a 4% return? No, because remember, he didn't put $200,000 down on it, or $1 million down on it. He put $200,000. And so if we take 40,000 divided by $200,000, that tells me his cash on cash return is 20%. While the person that financed it, right, is closer, right, is closer to 10%. That's the concept of leveraged returns. If we use debt the right way, and if we do it safely, maybe it can be an asset versus a liability. I'm going to hit on this, and this is something that's going to pass over. It like just passed over me at first when I first heard it. Whenever you buy a property, there's the potential to do something called depreciation. It's the thought of saying, hey, I'm going to depreciate this building according to a schedule that the IRS has. If it's a commercial or industrial, like a warehouse, it's typically a little bit longer. If it's residential, it's typically over 27.5 years. And then there's this thing there that allows you to depreciate some stuff over 5 years. This is what wealthy people I've found focus on. It's a concept called a cost segregation study. Cost segregation is not for everyone. You have to follow the rules, and we're going to get into a couple of those key rules. But long story short, when I bought a beach house last year, right? I bought a beach house for $3.4 million. The goal is that this beach house should generate around $300,000 a year of income. It hasn't yet because a hurricane hit Florida. That's okay. I'm in this for a long run. You don't do it because you think you're going to strike it rich on day one. But with that beach house, I'm currently getting a cost segregation study done. What this shows, because I'm something called a real estate professional. Now, I personally spend over 1,000 hours a year in real estate. We'll talk about why that matters, or maybe why 100 or 500 hours matter. But the thing is, out of that 3.4 million, I'm able to accelerate a portion of that depreciation. Again, I haven't necessarily lost anything, but I'm able to accelerate around $1 million of that. Why that matters for wealthy individuals is that there's a potential, if you do it correctly, right? There's a lot of YouTube videos I'd encourage you to go to that explain this concept. That if you are a real estate professional, we'll talk about how you can hit that, then you can potentially take that depreciation of $1 million and offset it against your day job income as a surgeon. You can offset that $1 million of depreciation against your other businesses, against your job as a vice president of engineer making 500 grand a year. What that could potentially mean is that when you go to file your taxes, you might get a tax return that is equal to what you paid in for the past year. And maybe there's residual that you can take over the next 5 years too. It's a really cool concept. It's not for everyone. It's a deeper conversation. We can spend 2 hours talking about this concept alone. It requires thought. It requires experience. It requires expertise. But the thing is, I personally love short-term real estate because there is I don't want to say it's a loophole because it's not. The IRS understands that when you own a short-term rental property, such as a beach house or lake house, that type of property requires more work than, for instance, if you have a long-term tenant who's locked into a 2-year lease in a townhome. With that said, they take a look at now having the house stand alone versus the individual become a real estate professional. They say, hey, right, we still want you to hit different types of testing. We want to make sure that you have the amount of hours in place. We want to make sure that, you're materially involved in this business, but the bar is slightly different than it is whenever you have a bunch of homes. The first type of real estate that I personally owned was a bunch of townhomes and single family homes. And if I had 200 grand of losses over here, and at my financial firm, if I made 200 grand over here, those two things did not intersect. Even though I had depreciation and losses over here, I really couldn't use it to offset my day income because those two things couldn't commingle. Has to do with different schedules, Schedule C versus Schedule E. But being a real estate professional moves this from a passive investment to an active, which means those two can offset each other. Again, I'm not going to try to get into it super deep today because we have 3 other concepts to hit. My goal is to wrap this up by 12:45. So that way we have some time for some additional questions. But again, the goal is to get you thinking. There's a lot of resources out there via YouTube or resources that we can provide. That's what we do, consulting, to help you make sure that you understand this. Is it a viable option? What should you do? I just think it's a really neat way to potentially say, hey, I've always dreamed about having a house in Rehoboth. And maybe on your own, if you're not planning to rent it out, I don't say it's a liability, but you're not renting out. It's not really an income producing asset for you. So maybe there's some potential appreciation, but I don't want to count on that. So with that home, maybe you can only afford, we do some math and it's 500 grand. That's the value. But if we rent it, maybe what we can afford is 1.5 now because we're having other people pay it down. It's a concept called other people's money, OPM, right? And this goes way back to what's called Rich Dad, Poor Dad, if you read that book. But it's a concept of saying, hey, let's utilize the bank's money, let's utilize our money, and let's utilize renters' money coming in so we can enjoy something that potentially is more than we should be able to afford on our own. But we want to do it smart. We want to make sure we have backstops in there because, heck, if a hurricane hits your house and you don't have any rental income for 6 months, you have to be able to afford that. Those are some risks. With the risk can potentially come the reward. Why I like real estate is not only the fact that it has income, not only that it have an appreciation potential, not only is it give me the ability to someone else pay down my debts for me, i.e. a $800,000 mortgage that is being paid down from people renting my house. But if you do it correctly, there maybe is a really nice tax benefit over the next 5 years for getting involved in real estate and following all the steps that the IRS sets out. All right, on to number 2. This is one of my favorite of all time. I love this, love this, love this. I cannot stress enough that if you are an accredited investor, this is something that is worthy of consideration. So, right, just like investing in solar, right, everyone knows that if you decide to get solar, it comes a tax credit, right? You get this tax credit for solar. Well, this harkens back to Eisenhower's days where he wanted, right? Congress wanted, they put in place basically rules that say, if you invest in energy infrastructure in America, we're going to give you some boons. And one of the boons is if you enter into an oil and natural gas investment as a general partner, then you have the potential to take depreciation on that oil investment. Long story short, with oil investing, right, you're able to potentially deduct 60 to 80% of that initial investment. It's a schedule that company that you pick. Again, that company is very broad, right? There's thousands of natural gas and oil companies out there. What I've done is I hired a company to help me vet and to identify and go from several thousand options to 2 or 3 that we really, really believe in and that have a value proposition that's different than others, which is why we picked them. The thing is, though, if you invest $100,000 in natural gas and oil, I happen to know that the target this year for one of the companies I really like is 60%, which means that you might get a statement next May. It's a K1 showing that there is a depreciable event of $60,000. That $60,000, you have the potential to offset it against your W-2 income. So what we're talking about is if you invest $200,000 in natural gas and oil, it has the potential to save you between $30,000 and $50,000 in taxes right away. Not only do I like natural gas and oil, is it pays dividends, right? Once the natural gas and oil gets kicking off, typically the dividends are pretty sizable, between an 8% and 20% plus return, either monthly or quarterly. I tend to like companies that pay monthly. My main thing is I don't know if you noticed already, I have ADHD. I don't like the thought of forever. A lot of natural gas and oil companies, when you invest in them, what happens is you put your money into them and you are in that company until the oil well sputters out in Texas, until after it's finished. I found a company that lets you basically divest within a typical 5-year frame. And what I like about that is that the thought is you put $100,000 in, the potential is within 5 years, you've pulled between $200,000 to $300,000 to $400,000 out. And hopefully we've done it again and gotten more tax benefits. And hopefully we've done it again and gotten more tax benefits. And we turned $200,000 into 1.2 within a span of 10 or 15 years. Natural gas and oil investing is not for everyone. Again, you have to be an accredited investor. That is the bar to get involved with this. You need to have someone who helps you find the right company. One of my buddies who works in the energy space, the very first natural gas and oil company he put his money in, he had a complete loss. And it was because that company didn't have checks and balances. It didn't have an independent auditor come in to make sure that the books were fine, because in fact, one of the CEOs or CFOs, I don't know the full story, but basically if they just did what they were supposed to do, it'd be a very profitable company. Instead, I'm pretty sure there was some type of embezzlement, right? So that's why it's trust but verify. And we spend a lot of time to verify a few companies that also have the verification process where they go through independent audits by one of the top 4 accounting firms in the nation. So we've already covered very, very briefly, your head's probably spinning so far. We've covered real estate. Now, if you buy real estate, specifically short-term rentals, and if you do it correctly, maybe there's a tax deduction. Maybe it's going to be a good use. But maybe if you've already been thinking of that condo in Vail, maybe there's a way for you to be able to afford it. And when you're not there, make some money off of it, right? You have to follow the rules. Can't be in an HOA, et cetera. I could talk about this for days. We've already talked about natural gas and oil. My goal every single year is to take money from different assets. I'm going to get into this with the 4th concept, which is called leverage. But the goal is for me to take a couple $100,000 a year and put it in natural gas and oil to help me have tax deductions, right? So that way I owe less as a business owner to the IRS. It's not about getting it to 0, but I sure would love to save 80 to 100,000 a year in taxes, right? And now we're talking about a concept called best use charitable donations, right? So very similar to what we talked about before, company matters, structure matters, integrity matters. Doing it the right way with the right company, with the right individual makes a lot of sense. For best use charitable donations, the benchmark is if you do not make over $700,000 a year, then this might not make sense to consider. We're not going to go super involved in here, but what this is, imagine this is the concept. Imagine if I don't really know much about baseball. I really don't actually. So no imagining required. And let's say Josh Lebo sitting to the left of me, he knows a lot about baseball. And I say, hey, Josh, I'll sell you a bunch of these cards for $1,000. I know that there's probably something in here. It's a collection for my uncle or something. Do you want this? And he's like, sure. So he pays me $1,000. And Josh, what he does is he goes through that and he spots 15 or 20 cards that he wants to send away to get appraised. He thinks there's a value there. Lo and behold, right, he finds out that the total card collection is worth $100,000, right? Now, hopefully as a friend, he would let me know that and at least buy dinner, right? But the idea is that that investment for him, right? He paid $1,000 is now worth $100,000. Well, I happen to know Josh. He's a super kind, super generous person. Let's say that the Wounded Warrior Association, or let's say the Salvation Army, he's a big supporter of them and he wants to donate. He doesn't want to donate $100,000 in cash, but he's like, you know what? I really don't need this $100,000 worth of cards. I want to donate this $100,000 worth of cards. Well, the receipt he gets from the Wounded Warrior Association is not going to be for $1,000. It's going to be what's called best use. And best use is $100,000 because that's the actual value. Similarly, best use charitable donations are for people that make north of 600 plus grand of income. What it is, it's the potential, right? You're buying a investment with the goal to actually produce coal. Right? You're buying this piece of land that's 1,000 plus acres. And the thing is, with this 1,000-acre piece of land, if you actually mine it, you're going to make a ton of money, a whole lot more than you would by donating it to the Wounded Warrior Association. But if for some reason you guys happen to vote and you decide to donate it to turn into a retreat center or donate it to turn into a counseling center for at-risk youth, whatever you want to do with the land, you give up the rights for the land, you give it away, and there's an opportunity to have what's called a best use donation. Because after all, let's say the land was purchased for 20 million, but the value of the coal is worth 100 million. That would mean then that the donation turns into a 5x multiple. Again, we don't need to cover more today, but just know that there's some strategies out there that you can donate stuff to. Again, you need to make sure that you're using the right company. There's a lot of unscrupulous companies in this space that try to say the multiplier is 15% or 8%. The IRS is going after them hard, and rightfully so. What they're doing is they say something silly like, this land that we purchased for $1 million, we're going to put a skyscraper on it that's going to be worth 100 million. So we want to donate it for 100 million. No, It's not worth 100 million. It's only worth what you paid for it. But if you can prove and have done independent tests to say, no, this land we bought has oil underneath, it has coal underneath. Independent appraisers say that when we extract it, it's worth 150 million. And the donation amount they take is 100. That gives them a lot of leeway with the IRS. Again, not a complete expert in this space. You always need to consult with your CPA. But at the same time, this is a strategy that is worth considering if you have the right company that is doing it with integrity. All right, let's get to something I can talk about forever. This is how the wealthy continue to make money. This is how the wealthy continue to have tax rates that are far below what you and I used to pay. I say used to because I haven't paid taxes, at least a lot of it, in years, because I've employed a combination of these plans and strategies myself. Again, practice what you preach. So stock market and leverage. This is a concept that I absolutely love. It's the concept of when you have a dollar, let's use the whole dollar. Let's do it safely though, right? I'm not saying let's take it down to Atlantic City and let's gamble it away, but there's a potential for us to use our money wisely. And there's a potential for us to do something called becoming your own banker. With stock market and leverage, right? If you have a $1 million investment account with me, that's not in a retirement account. That's the catch, right? You can't borrow against your retirement account. One of the reasons why I'm at the platform that we are at Seaside and Jenkins Financial is because Interactive Brokers has one of the lowest margin rates out there. If you have a $1 million investment account, you are able to borrow up to $500,000, right? So 50% of the account balance, you can borrow that, and there's no credit check. There is no 50-day hold. You're able to borrow that money and have it deposited in your bank account relatively easy. And the current rate is around 5.5%. So let's say that you have a $1 million investment account and you really want to get involved in real estate. You'd love to put some money into natural gas and oil. But if you liquidate that $1 million, there's going to be taxes because you bought NVIDIA, you bought Tesla back in the day, and you're going to have this big tax bill if you sell $500,000 worth of shares. Maybe the tax bill is 100 grand, maybe it's 50. And what you decide to do instead is borrow against your stocks. When you do that, what you're doing is you're making a logical bet, because it is a bet. You're making an assumption or presumption that your stocks that you own have the potential to make you more long-term than 5.5%. All right. And if you don't think that's the case, then you shouldn't borrow against your stocks. If you think that the stocks you own have hit a precipice and it can't go any higher, then maybe it's time to divest. Maybe it's time to get out of those and actually pay cash for something. But if you think that those stocks have the potential to make you more, the idea is that you're not liquidating those stocks, so you have the appreciation potential. Now you're also taking the risk. What's the other side of the coin? You could actually lose funds too, especially short term. But if you take that money and you borrow it, first off, it's interest only, right? Coincidentally, I build portfolios, so the dividends of those stocks between Target and AT&T is roughly equal to that payment. So there's no payment due for most people. And what do they do with that $500,000? Maybe they decide to buy a beach house. Maybe they decide to invest back in their own business. Maybe they decide to put that in natural gas and oil, and they put 200 grand in, and it gives them a $50,000 or $60,000 tax deduction, right? Just like that, which is more than the interest cost would have cost them from borrowing. It's an interesting concept to say, okay, Josh, if I borrow 500 grand and that costs me 25,000 a year of interest, is what I'm buying into have the potential also on the flip side to make me more than 25 grand? And again, I'm not saying we should run out and put our money in crypto, right? We should do tried and true methods. And we've seen how real estate works over time. If we can do the right type of real estate and get value add, i.e. don't buy something at the top of the market, maybe the potential is that you can make money on both sides of the table. Maybe the potential is that if you put that 500 grand into natural gas and oil with a 60% deduction, that means about 300 grand is coming off of your tax taxable income. So that saves you about $120,000 in taxes, just very roughly. Well, the cost of borrowing was 25 grand a year. But if you save $100,000 in taxes plus, that's 4 years worth. Not only that, the natural gas and oil, after a year or so, when those wells get spun up, maybe it's making 8 or 10% in dividends. Maybe it's making 50 grand a year. And all of a sudden you are in a situation where the cost of borrowing that 500 grand is 25 grand a year, roughly, with current rates. But the oil and natural gas is making you 50. And then there's a potential for exit where 500 grand turns into 800 grand or turns into $1 million. You can take that profit or take the principal, put it back, and now you have a couple $100 grand more than you did the day before. That's the concept of leverage. It's not for everyone. You need to have an advisor who specializes in understanding risk and assessment and leverage, because the last thing you want to do is put it onto something that can go to zero, right? You don't want to put all of your money in this one private equity company that just started last year. No. Diversification, experience, integrity, but trust but verify, to say, hey, is the company that I'm investing tried and true? What's their checks and balances? Do they open up their books? There's a lot of different things that you need to consider before you just try to decide to make money on both sides of the table. Why I love real estate, though, is it's a form of leverage. I have clients that bought a beach house last year in cash. Now, they didn't take cash. What they did was they borrowed against their investment accounts with me, right? And what we've done then is maybe they borrowed 1.8 million to start. They bought a beach house in an island that I like, that has the potential to make around 200 grand a year of income. I think currently this year it's like 150, 155 of income, right? They borrowed that money. And then what did I do? Right? I sold off some of their shares in November. So they don't now owe 1.5, they owe 800. So they don't owe the full amount, but we still have debt and liability against that. The goal of the advisor, in my opinion, is to help them manage risk and expectation, and when also to exit. We made this client a lot of money over the years, and I wanted to go ahead and take some of the risk off the table by paying down some of his debt. But the thing is, he was able to buy a beach house in cash because he took money from his line of credit, from his margin loan, against his interactive account, which is just so neat. Not only that, if you try to buy a piece of real estate right now, rates for second homes or for beach homes, stuff like that, it's probably in the low sevens. He was able to borrow at less than 5.5. That's really cool. So I love leverage. Not only do I love leverage, wealthy individuals love leverage. They understand it. But the thing is, before they do anything, they educate themselves. They make sure their competency is up in all of these different subjects. Please do not take my word for it. And just because I had this conversation with you, you find this random company to do a best use charitable donation. You decide to borrow 500 grand against your Charles Schwab account and you invest it in penny stocks. That is not what I'm saying. The goal is to use wealth and use it wisely, understanding how those 4 key concepts can add to your financial plan. It's not about saying, I'm not going to invest in the stock market. It's not about saying, I'm going to do all of this. I'm all in with this. But if we have additional players on the chessboard, the goal is for us to play chess, not checkers. And again, one of the reasons why I'm at Interactive, just this morning, I was talking with a client. They thought that one of their residents was able to borrow at 2.5% roughly. And I was like, impossible. You can't do that. Turns out it's 2.5 plus what's called SOFR, which is a lending rate. So his rate's 7.5 at Charles Schwab. Meanwhile, my client is able to borrow against his own account at 5.5. That's pretty cool. So one of the things I wanted to hit on before our time's up and we open things up to questions is, how much should I plan for? This is getting a lot of misconceptions out there, because there's a difference between how much money you have and can you correlate that over to an income stream. I actually have a private equity investment that pays 10% returns backed by hard money lending. It's paid quarterly. There is limited liquidity for the first year, but if you want your money back after that point, you're able to get it back within about a month or so, right? So there's no need to have annuities anymore. And the goal is, hey, you put $1 million into there, well, that's $100,000 a year, and it's backed by real estate, right? So there's different ways you can increase your income without purely leaning on stock appreciation. If all you have is NVIDIA in your portfolio, you're going to be in for a really good ride up, but potentially, like we've seen recently, a really hard ride down. It's about diversification, about positioning your different assets. It's about maximizing your assets. And wealthy individuals don't rely on it totally on insurance. They don't rely on annuities. There's other things out there that can provide better yield, like hard money lending, which we did not get into today. So the goal is, though, to saying, listen, if you want an income in retirement of $200,000-300,000 a year, we need to have a little bit more than the average mom and pop. We need to have several $1 million split between different assets that indemnifies us as well as we can from taking risk, right? Oil prices go down. Well, thank God we don't have everything in oil. Stock market goes down. Well, thank God we have money in income producing real estate. Real estate rates go up or down. Well, thank God we have money in the stock. We want to have diversifications. And what wealthy people do is they diversify smartly. They keep liquidity and they borrow against their assets to buy more assets when the time is right for the right deal. So final tips. Talked about this. I don't need to go over this right now, but the goal is that hopefully you've gotten something out of today. Hopefully you've taken a look and just reshape the conversation in your head of saying, you know what, maybe there's some asset classes that my wife and I, that my friends need to explore, especially given the fact that we've helped clients working in conjunction with their CPAs save, if not hundreds of thousands, closer to the 7-figure range in taxes, right? We're not tax consultants, but we understand, though, that if we do things and do things right and diversify and use the tools that the IRS has for us, these are all legit strategies. This is no gray area where we're going to, touch the wire and see if it's electrified or not. No, these are tried and true methods that other people have been doing successfully. Wealthy individuals have been doing successfully for decades. So final tips and takeaways. Have an independent advisors playing chess, not checkers. Have a CPA that works for you, not the IRS. That's one sort of combative. I know we have a couple of CPAs actually on this call, right? I appreciate the work that you do. But at the same time, I would encourage CPAs to look ahead. I can't tell you how many times I've come across a CPA and they say, I can't do that. And then we send them the red letter ruling. We send them the Supreme Court decision. We send them the opinion from Colorado Supreme Court that shows how it's done and why they sided with this company, right? So it's important to have the accountant give that pushback of saying, I'm not just going to be doing your taxes for you, but I'm going to be helping and working with your advisor to try to mitigate taxes moving forward with legal strategies. Consider adding private markets, private credit, real estate. All these things are worthwhile talking to, but you need to work with an advisor who has expertise in those spaces. Consider becoming your own banker by having a line of credit against your stock account. I love the potential, and I know it's hard for me, especially the past few months, to take a look at the value of my investment accounts going down. But I believe long-term that if I borrow against stocks, that is a better proposition than liquidating my stocks and losing the potential to make money in them. All right, so what I'm going to do now is I'm going to open this up to some questions if we have any. So let me take a look at the Q&A to see if we have any questions. Go ahead and type some in if you have some. If not, then we're going to wrap things up here. And the ask is this, like, we have all of your contact info. I see some clients on the call. I see some clients that I haven't talked to in a while. I see some people that I haven't interacted with at all. We're going to go ahead and get this out there. I'd encourage you to share this webinar with people that you think it's appropriate for. High-income earners, people that are griping that their financial advisor, all they're doing is recommending the same thing over and over again. It's not that the financial advisor is a bad person by any means, but when a financial advisor works for a bank, then they have a boss that tells them what to sell. I had that the first 10 years of my career, and I wish I knew it sooner. I wish I knew, looking outside in, that the grass is actually greener by going independent. I have nothing but respect for my previous company. They taught me a lot. They allowed me to just become, I think, a version of the person I am today. And it was a good stepping point off, but being independent allows us to look from the outside in and really do things a different way. Really focus on strategy and education. And hey, you want to find companies in these spaces, great. We found companies, we built relationships, we get paid if we connect you to those companies. That's how it works, right? Because we've done a lot of vetting and we've paid fees to vet these companies. But at the same time, though, we're trying to play chess, not checkers. So let's take a look to see if there's any questions. I don't think there is. So again, hopefully you enjoyed today. Hopefully you've taken a tidbit. I would encourage you to follow up with me. I'll send a follow-up email later this week. And for people that I don't know, but even if I do know you, if you can think of a few people to send this to, I would appreciate it. We're hiring, we've added staff, we're growing, and our goal, though, is to work with people that we can make a meaningful difference to. We can help them invest better, leverage better, understand the relationship between debt and investments, helping them just look on the outside in and make them realize their goals just a little bit better by adding in tax efficiency to the mix. So, all right. Well, thank you so much, everyone, for joining today. We're going to go ahead and stop the call since there's no questions at this point. All right. You guys take care. Bye.